This is part 1 of the Chapter 5 lecture series on recording transactions related to the purchase and sale of inventory. Let's get started. Thus far, we have focused on service companies, which are companies in business to provide services. In Chapter 5, we are switching gears and we are going to discuss companies that are in business to sell products. These types of businesses are known as merchandisers. There are two types of merchandisers: retailers and wholesalers. Retailers sell to end users like you and me. Wholesalers sell to retailers. Instead of using service revenue, we will use sales revenue, sometimes just called sales. We will also have two major categories of expenses: cost of goods sold and operating expenses. Cost of goods sold is the total cost of the merchandise sold during the period. Remember, this is an expense even though it doesn't include the word expense in the title. Operating expenses are other expenses related to the normal operations of the company, such as insurance expense, rent expense, salaries and wages expense, depreciation expense, and so forth. We will also have a new asset account called inventory. Inventory is the cost of merchandise that a company has not yet sold. We will use the terms inventory and merchandise interchangeably in this chapter. As a recap, cost of goods sold is an expense. It's what we have sold during the period. Inventory is an asset, and it is what we still have on hand. There are two types of inventory accounting methods: perpetual and periodic. We will only learn the perpetual method. Under the perpetual method, the inventory account is adjusted every time a company buys and sells inventory. Therefore, the inventory account should always reflect the current amount of inventory on hand. Also, the cost of goods sold is determined every time a sale is made. There are numerous general journal entries that are unique to merchandisers, both for the purchase and sale of inventory. We will go through these entries using an example. The order of the entries in the example is the same order in your notes, so it will be easy to follow along. We will begin with the entries related to the purchase of inventory. In this example, SOC Stereo is buying inventory from PW Audio Supply. So, we will go through the entries for SOC first and then PW Audio Supply. Remember, right now we are taking SOC's perspective. It is always important to remember which company's perspective you are taking, the buyer or the seller. Right now, we are taking the buyer's perspective. As indicated on the invoice, SOC purchased this inventory on account. The reason we know that it was purchased on account is because the credit terms are provided. We will talk about these terms in just a minute. We will apply the rules that we learned in Chapter 3. We know that we are purchasing an asset, so we need to debit the asset account inventory, and we should credit accounts payable because we are purchasing on account. Same rules as Chapter 3. We're just now using the new account inventory. Now let's talk about freight. Freight costs are the same thing as shipping costs. There are two types of freight terms: FOB or free on board, shipping point, and FOB destination. With FOB shipping point, ownership of the goods passes to the buyer when they leave the seller's facility. So, because the buyer owns the goods during transit, they are responsible for the freight. On the other hand, with FOB destination, ownership of the goods does not pass to the buyer until it arrives at the buyer's facilities. Therefore, the seller is responsible for the freight because they own the goods during transit. Let's assume the agreement between SOC and PW Audio Supply calls for FOB shipping point. The ownership passes to SOC when the goods leave PW, so SOC is responsible for the freight. The question is, what journal entry do we need to prepare? They are paying the freight, so we know we need to credit cash. However, what do we debit? You may be thinking that we should debit an expense, but that is incorrect. We actually debit inventory. When the buyer pays freight, it is not expensed when paid. We do not expense it until the inventory is sold. Now let's talk about purchase returns and allowances. If the buyer is dissatisfied with the goods received, the seller may award them a purchase return or a purchase allowance. A purchase return involves the buyer returning the goods to the seller for credit. A purchase allowance involves the buyer keeping the goods, but the seller granting the buyer a reduction in the purchase price. The accounting for purchase returns and purchase allowances is the same. Assume that SOC Stereo returned goods costing $300 to PW Audio Supply on May the 8th. The entry that we prepare is simply a reversal of our original entry to record the purchase. We debit accounts payable because SOC will never owe that $300 to PW, and therefore we need to reduce accounts payable. Please note that we directly credit or reduce inventory. There is no separate account for purchase returns and allowances. Next, let's talk about purchase discounts. Sellers often offer buyers purchase discounts for paying early. If the seller is offering a purchase discount, it is indicated in the credit terms mentioned earlier. The most common example is the first type of discount indicated here. It is read $210 net 30. This means that the total amount is due in 30 days, but if the buyer pays in 10 days, they get a 2% discount. There are numerous variations to this type of discount. For example, $115 net 45 means that the total amount is due in 45 days, but if the buyer pays within 15 days, they get a 1% discount. Now let's continue our example. Remember from the sales invoice, PW offered credit terms of $210 net 30. So again, SOC must pay within 30 days, but if they pay within 10 days, they get a 2% discount. We are to assume that SOC pays PW on May 14th, which is within the discount period. So we need to calculate the discount. The amount due to PW before any discount is the original $3,800 less the $300 return, or $3,500. We then multiply this amount by 2% to calculate our discount. When you do the math, the discount amount is $70. By paying early, SOC is getting a $70 discount. So the net amount owed after discount is $3,430. This is the amount that SOC will actually pay. Now, let's look at the entry. We know we need to debit accounts payable because we are paying on account, but the question is, by how much? We actually debit accounts payable by the entire amount in accounts payable, which is $3,500. The reason why we have to debit accounts payable for the entire amount is because if we only debited it by $3,430, we would be leaving $70 in accounts payable as though SOC still owes PW $70. Does SOC owe PW that $70? No, they do not. This $70 represents the discount offered to SOC for paying early. Because they are paying early, they will never have to pay the $70. We also know that we need to credit cash for the amount of cash SOC paid. We calculated this amount earlier to be $3,430. So we have a debit to accounts payable for $3,500 and we have a credit to cash for $3,430. Are we happy with this entry? No, we're not, because it doesn't balance. We need a credit of $70 to balance the entry. We credit inventory for this amount. Similar to purchase returns and allowances, we directly credit inventory for purchase discounts to reduce our inventory so our inventory balance reflects the true cost of our inventory. Remember, there is no separate account for purchase discounts. If SOC didn't take advantage of the discount, the journal entry to record the payment would simply involve a debit to accounts payable for $3,500 and a credit to cash for $3,500. After posting these journal entries, the T account for inventory looks like this. We debited inventory for the purchase price of $3,800 and the freight of $150. We credited it for the return of $300 and the discount of $70. So the net cost of our inventory is $3,580. Now let's look at the journal entries related to the sale of inventory. We are going to look at the exact same transactions as before, but now we are going to take PW Audio Supply's perspective. When we sell inventory, we must make two journal entries. The first is to record the sale, and the second is to move the cost out of inventory and into cost of goods sold. In the first entry, we debit either cash or accounts receivable depending on whether the customer paid, and we credit sales revenue. The amount of this entry is the selling price. The second entry involves a debit to cost of goods sold and a credit to inventory. The amount of this entry is the cost. Now, let's look at our example. Remember, PW sold $3,800 worth of inventory to SOC. The inventory cost PW $2,400. So, we would debit accounts receivable because SOC purchased on credit, and we would credit sales revenue for the selling price of $3,800. We would then debit cost of goods sold and credit inventory for the cost of $2,400 to move the cost from inventory to cost of goods sold. Now, let's assume that the shipping terms were FOB destination. These terms imply that PW owns the goods during transit and are therefore responsible for the freight charges. When the seller pays freight, it must debit an expense account called freight out. This treatment is quite different than when the buyer pays the freight. When the buyer pays freight, it must debit inventory. PW is the seller, so they would debit freight out and credit cash for the freight cost of $150. Now, let's look at sales returns and allowances. Sales returns and allowances are simply the flip side of purchase returns and allowances. The seller's customer is dissatisfied with the items received from the seller. The seller may choose to award the customer a sales return, which would involve the customer returning the goods to the seller and the seller giving the customer a credit, or the seller may choose to award the customer a sales allowance, which is simply a reduction of the selling price. Let's look at our example. SOC returned $300 worth of goods to PW. Because the items were returned, PW must make two entries to record the return. The first entry involves a debit to an account called Sales Returns and Allowances. This account is a contra revenue account, meaning that it is in the revenue section, but it reduces revenue. We do not directly debit sales revenue because we want to keep up with our sales returns and allowances in a separate account. We would also credit accounts receivable to reduce it because SOC does not owe the $300. The second entry is simply a reversal of the second entry prepared when we recorded the sale. We would simply debit inventory to put the goods back into inventory, and we would credit cost of goods sold to reduce it because PW didn't really sell the goods. The amount of the first entry is the selling price, and the amount of the second entry is the cost of the inventory. Sales allowances are treated a little differently than sales returns. If PW issued a sales allowance instead, we would only prepare the first entry. The second entry would not have been prepared because nothing would have been returned to PW. Lastly, let's talk about sales discounts. A sales discount is offered by some sellers to motivate buyers to pay early. Remember from our example that PW offered SOC credit terms of $210 net 30. Again, this means that PW is requiring SOC to pay within 30 days, but if SOC pays within 10 days, it gets a 2% discount. The numbers will be the same as before. The amount in accounts receivable is the original selling price of $3,800 less the returned item of $300 or $3,500. The discount is $70 and the total cash received is $3,430. The entry would involve a debit to cash for $3,430 and a credit to accounts receivable for the entire $3,500 because remember, PW granted SOC a $70 discount, meaning that they will never collect that $70. So, we are in need of a $70 debit to balance this entry. We debit an account called sales discounts. This account is similar to sales returns and allowances in that it is also a contra revenue account. This completes part 1 of the Chapter 5 lecture series on recording transactions related to the purchase and sale of inventory. Have a great day.